I think these numbers today won't be much surprise to the RBA. We have known all year that public demand has been very strong, and you mentioned a modest downgrade to GDP for this financial year from 2 to 1.75. Public demand has been upgraded from, let me just check my number there, 1.5 to 3.75%. So a big increase in expected growth in public demand, and that's been you could look at it two ways. You could say public demand has been helping support the economy at a time of weakness elsewhere, particularly given high interest rates. But more, it's actually preventing the RBA from cutting interest rates and supporting the private sector because of the overall level of we're running at high levels of utilisation, not a lot of spare capacity. And so the more the government spends in the short run, the less the private sector is allowed to spend through the Reserve Bank. So that's the way I see it, as the public sector at the moment, for good or bad, is crowding out the private sector and keeping interest rates higher than they would otherwise be.
Okay. The other angle is on the revenue front, revenue projections. How do you see the government working in that, given that this is a commodity exporter? Australia is a commodity exporter primarily, and we know that commodity demand has been a bit sluggish thanks to China.
Yeah, so overall the revenue outlook for the budget has been upgraded. Now, private expected growth in personal taxes, what the average taxpayer pays, that's been upgraded because wages outlook has been upgraded. The employment numbers in Australia have been stronger than expected. I mean, that's been another upside surprise this year. So revenue overall has gone up in terms of expectations, but company profits, as you point out, have been downgraded, particularly mining sector profits. Now, one of the reasons there is oil prices they've downgraded their oil price forecast, but iron ore, importantly, iron ore prices, which are a big driver of profits for our mining companies, haven't been downgraded. And in fact, the government's forecasts for iron ore are still relatively conservative. They've got the price coming down from around $100 a tonne at the moment to about $60 US middle of next year. So that's still a conservative assumption. So you can't really blame anything in today's budget on a weaker than expected iron ore outlook.